This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Hello? 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 This is the Vancouver
Commercial
Real Estate Podcast.
Back to the Vancouver Commercial Real Estate Podcast. I'm Cory Wright.
And I'm Melisa Moretti.
And I'm back.
You're back.
I'm back. This is we had Adam and Matt's episode we launched 2 weeks ago, which they were kind enough to have me on. So we kind of put that on both sides. So we got the story out there. Then last week we had a great episode we previously recorded with Brian Pilby up there in Kamloops because I was in San Diego.
Yeah. What were you doing in San Diego?
What wasn't I doing in San Diego? I would highly encourage anyone who hasn't been to San Diego to go. It is amazing. But I will say this. It's an amazing 4-day city.
Right.
Don't necessarily know it's a 7-day city.
What were the highlights?
We saw the Padres game, which was awesome. Which was, I guess in hindsight, this just goes to my lack of buying baseball ticket knowledge, is we end up getting like row 5 right behind the first base side. And I'm like, how did I get these tickets so close to game day?
Yeah.
Well, it was a 1:00 start. And that section happened to be the section that had sun burning on it the whole game. So everyone who was smart that's been to the game, we're all sitting in the right sections where they had shade on them. Not us. We were literally in the right down there, just got torched.
I was wondering why you were extra red today.
Yeah. No, just got torched. So we did that. And then all the SeaWorlds and the San Diego zoos and Legoland. Legoland, for all those who haven't been.
Okay.
A 45-minute drive from downtown San Diego to Carlsbad. Definitely not worth the 45-minute drive.
I don't know if I'm convinced that I'm going to be going to San Diego anytime soon. None of that sounded like anything I would go to.
I will say, like, San Diego is kind of like Vancouver feeling, but more like surfer meets Vancouver.
Okay.
So it feels very safe. I found an old spaghetti factory. I did.
Again, nothing I'm going to San Diego
I found an old spaghetti factory about 2 blocks from the Padres Stadium.
Travel tips not happening here today.
Yeah, but for a quick 3-hour flight, food was great. I went to Cheesecake Factory, I think like 3 times when I was there.
So you're all rested. You're good to go. You're ready to go.
I'm back. I'm excited to be back on the podcast.
I can hear it in your voice.
On today's episode, we have the amazing Meg Cooney from our Vancouver office.
We love Meg.
She's great, talking all about the office market. And by that, I mean, is the office market your best investment right now?
I would like to know that.
I would too. So I think we're going to talk all about that. We're going to dive into it because obviously there's a lot of negativity that's been in the news about the office market.
Right.
Coming out of the post-COVID era, all of that stuff. So we're going to dive into it today to peel back the onion and find out, is this your best time to maybe buy office?
Yeah, because my first instinct, not knowing too much about commercial office space, would be no.
That could be the problem right there.
We're going to debunk that.
We're going to debunk.
Maybe.
We're going to debunk that. We're going to find out. We're going to find out today on the episode.
All right.
So without further ado, let's get to our episode with Meg Cooney of William Wright Commercial Vancouver.
All right, let's go.
This week's episode is brought to you by our great friends at Impact Commercial Group.
Really enjoy working with Impact Commercial. And we should say Al and his team can basically do anything when it comes to lending.
Anything when it comes under the commercial umbrella. You're building a building in development, we got you covered. You're buying land, we'll make that happen for you. You're investing in a property or multifamily building, check. Owner-occupiers looking to acquire their own space, double check. Anything commercial financing you need, Impact Commercial is your go-to.
ImpactCommercial.ca. And we should say, over 50 years of combined experience. So trust these guys. They're the right fit.
Best in the business, in my opinion. All right, we're here today with Meg Cooney from our Vancouver William Wright office. And for those listeners who have heard Meg before. Matt would call her what does Matt refer to them as? Fan favorites?
Past guest fan favorite.
Past guest fan favorite,
yes.
as Matt would say.
Gosh.
Meg, the emails that we get to have you back on could fill most people's inboxes in an hour.
On the daily.
On the daily.
You guys are too kind. Too kind.
See, if we treat you nice, then you can always come back on, right? We always need future guests. We can rely on you.
Yeah, I mean, I think it's an annual thing. I was looking back and it was 2021, 2022, and look where we are, 2023. So I will be back in 2024, I guess.
Fingers crossed. Fingers crossed. Meg, the reason why we wanted to have you on today is there's a lot of negativity you read out there in the post-COVID office market. So, if you're reading things down south, it's kind of like, office buildings are getting foreclosed on. Up here, you're reading about higher and higher vacancy rates. But traditionally, when you're looking to buy something, you buy low, sell high.
Yeah.
And where I think a lot of people make the mistake in the investing commercial real estate game is they will buy when that asset class is hot. Maybe industrial a couple of years ago, or maybe industrial last year, where it kind of seemed like, almost feels like it peaked a little bit, where people are buying at the top of the market. But right now, in the post-COVID era, higher vacancy than we traditionally have seen here for the past couple of years, all the negativity you're seeing in the media, mainly pertaining to the down south markets. The question we have to ask, Meg, is now a good time for office? So let's break that down. Let's start off with, where is the office market today in the greater Vancouver area?
So prior to the pandemic, looking at Q4 2019, the office vacancy rate for Metro Vancouver was hovering around 3%, with the CBD closer to 2%. So, this is what we'd consider an unhealthy vacancy, where the sublease and the sublease markets were incredibly active. Very rarely would you see an actual head lease available and, gone within a day with multiple offers. So this sparked a surge of development applications to increase office supply. Obviously, developers were seeing this need, this demand. And so you get projects such as Bosa Waterfront, Profile, VC2, One Burrard Place, all pursuing applications to create more office product. Fast forward to 2023, obviously with the work from home movement, changes in the tech space, and newly introduced office stock, vacancy rate in Vancouver is now around 12 to 13%. And although Vancouver hasn't experienced this level of vacancy in a long time, we're not far from what's considered healthy. I think healthy is typically anywhere from 4 to 8%. And so, although it is drastic for us in Vancouver because it was so tight for so long, we're actually sitting in a pretty healthy absorption market. You look at Seattle currently, San Francisco, New York, they're hovering around, 24%, 32%, 20% respectively. So,
wow.
I think the crisis for us is just because we've been in, a vacancy market, which has been so good for so long. And developers kind of reacted to that, creating more supply, which was needed back then, but not so much now. That's really what's buzzing in the media.
So I want to jump in here as well and provide a little bit more to your story there. So Meg talked about a tremendous amount of office space that all sort of coming to fruition and has come to fruition in the past, year to 2 years, and some more coming down the line. Anytime we look at these numbers too on the vacancy side of it, if you're getting a ton of new product introduced to the market at the same time and it's not fully absorbed, you can actually see a little bit of an uptick in some of these numbers, which I don't want to say is like a false indication of what it is, but this is product that didn't previously exist. So if I have two things, if I have two houses and another house finishes at the same time, but I haven't sold the two houses yet, you could argue to say that the listings have grown by 33%. But really, they've grown, that 33% is just new product that's been introduced. So when Meg's talking about these vacancy rates, although they do feel higher for Vancouver, but overall are very close to balance and healthy markets, we've just been very fortunate that hasn't sort of been the market we've operated in from a landlord perspective for the past little while, is there could be some underlining things in those numbers that might make them feel a little bit higher than maybe necessarily what they really are, just because new product hasn't been absorbed as fast as they maybe first thought.
Absolutely. And I think the opposite is true as well. I think developers are now looking at the vacancy in the downtown market or other markets such as like Broadway. And, they're switching gears from building office space because they see the amount of supply. And so it's kind of cyclical in that sense where, when there's a need, developers will build for that need. And as that kind of changes, they adjust accordingly. So, I think we're heading into a market, as you said, Cory, where, that product will eventually be absorbed.
Totally.
Demand is still there, things are changing. But, I think also the market is reacting as well. So maybe we won't be seeing that amount of supply in future years to come.
I think one thing too, like if you look at downtown Vancouver, it pretty much is an island almost.
Yeah.
Where there's not any more land. And the difference between downtown Vancouver, say maybe versus downtown Seattle, or even, downtown San Francisco, where maybe you're walking through the downtown core and it feels very kind of like hollow feeling, is in Seattle, and again, I'm just making these numbers up, it's probably like 70% office space to 30% residential and hotels.
Right.
So if the offices aren't as occupied, naturally it's going to feel a little bit empty. In downtown Vancouver, we're probably 70% residential to 30% office and hotels. So even if the offices aren't as busy as they once were, you still have all these residents, which makes the downtown core feel very, very lively. And we're very fortunate in our city that people live downtown. Has anyone heard of anyone living downtown Cincinnati? Like there's not as many downtown cores that people live in as we think. Vancouver is an anomaly with how active and vibrant the downtown core is. And a lot of that is because we are surrounded by beautiful water and mountains, that you've got all these scenic places to go and things to do, plus a great food scene and all that stuff, which makes the downtown lifestyle very, very vibrant. And that's where Vancouver office market, I think, regardless to where we sit today, will continue to backfill itself year over year over year, because we just don't have the land to work with, versus a Calgary where you can build for days, that if they need more, they can just build more, versus downtown Vancouver, you won't be able to do that. And although we are seeing Meg, you might know this better than I do, a decrease in the vacancy rate, maybe in office space out in the Fraser Valley areas versus the downtown core, downtown is still downtown. And companies are still going to want to occupy with a Vancouver address. They're still going to want to be in the downtown marketplace overall. So that being the center ice of the Lower Mainland's office market, I think regardless to where we're at today, that market will backfill itself, and 2 or 3 years down the road, the vacancy rates won't be nearly as high. I can't say for sure if the lease rates will be as high as they are today, but the vacancy rate, I think, is confident to say that will definitely come down and be a much more of a more aggressive office market like we previously had.
Yeah, and I think you touched on two really key points there, and that's population. So, the fact that we have such a nice blend of residential density coming into downtown, and then other parts as well, such as Fraser Valley, Tri-Cities, that all supports the office market. It all supports the retail market as well. And so to have, those kind of micro, economies where everything is firing at once, and the population supports the office, it supports the retail, it's a lot more positive than those metropolitan cities such as like Seattle, as you mentioned. There's less people living there to support, those office buildings.
And I think one thing too is when we talk about like the vibrancy of like the downtown Vancouver, if you walk downtown Edmonton, you don't see nearly as much retail at grade, and you don't see nearly as much vibrancy at the retail level at grade. And one of the bigger drivers of that is, you ever walked around downtown Edmonton in February?
You can't.
It's freezing.
You will freeze to death.
So that's one thing too that we benefit out here is our climate is not the same as you would find in Alberta or even Ontario for that matter. When you go to Ontario, they've got tunnels that connect buildings because it's so cold, versus Vancouver, we don't have that, which forces people to walk on the street, creates retail vibrancy. All those unique things I think will play into that makes our downtown office market much more unique than most of them in the country.
Absolutely. And I think also just touching on the suburban markets as well, it's not always the traditional kind of tech groups that are going out there. I think, the response to the work from home is, having satellite offices that are closer to where people actually live too. So, with the population growth in the Fraser Valley, for example, a lot of these kind of HQ Vancouver offices are expanding into the valley. And so, their vacancy might be a little bit different in terms of absorption. There's also, different players in the space. Medical groups have, been recession-proof, I would say, and they need space in communities where there's growth in population, right? So it's not just the tech boom and bust. It's, the day-to-day needs and essentials across the Lower Mainland that are filling these office spaces.
Yeah, no, I totally agree with you. And I think, BC as a whole, as we have more immigration come into the country and all that stuff, people are ending up here in BC, and eventually these people are all going to need somewhere to work at some point in time. And again, even when you look at the cost now of land acquisition costs, numbers are harder and harder to probably pencil on the office side if the lease rates pull off versus that land being sold for stratified condos. So that will also impact the growth of that asset class, which may not grow at the same pace it once did in the past recent years. That developers may not be able to pencil them the same, which then that naturally, obviously with high interest rates and construction costs, will all influence the ability for that office building to be built or not built.
Yeah, no, it's such a great point. Like you look at replacement costs of these buildings and construction costs, that has been, a concern since the beginning of COVID, and they've continued to rise. So beyond just the interest rate impact, construction costs are, really impacting the land market. Does it make sense to rebuild something that's a 4-story just to add an additional, 2 stories on that building? No, probably not. So, it's definitely kind of creating a pause in development for new product.
Well, I can even tell you too as well. I remember there was a building that we had a client that they acquired that I think they paid around like $4.5 million for, and the replacement cost value on the building was like over $10 million.
Wow!
Because the construction costs were so expensive, but you would never buy that property for $10 million because that would never make sense.
Yeah.
So the chance of someone buying the land and then building that same structure doesn't make any sense. No one's gonna look at that and say, hey, let's buy the land and build it for $10 million when it's probably worth $5 million when we're done with it. That's not going to happen. So that's going to make less product available. Now it's a Vancouver Island market. That's going to make less product available. But that's just a great example of when you're looking at the replacement cost values from these assets with today's construction world.
Yeah.
You can't buy and build them for the same price you can buy them that are already existing.
Absolutely.
So that's going to naturally stop new supply coming on the market with time because the cost to buy and build it won't make sense.
Yeah. And just investing in that existing asset and, paying that CapEx and improving it just to increase its longevity.
Yep. No, I 100% agree with you.
So with all that said, do you think it's a good time to be investing in the office market right now?
Yeah, that's a great question. When seeking investment opportunities for a client, we like to strike in sectors that are not operating at full potential and at a price that provides room for upside. I know that the lending environment has been a major point of discussion across all media, even including this podcast. And the question really becomes this: I have capital to deploy that is eroding due to inflation, but is it better to pause on buying activity right now, or is now the time to be bullish? And I believe now is a great time, especially if you're a well-capitalized investor, to take advantage of sharp pricing we're seeing, the rising cap rates, interest rates increasing. And, because as interest rates start to fall, that's when you see cap rate compression. And effectively, you're increasing your value in your investment with this compression that will, happen over time. The market is cyclical. We've seen it at that 2 to 3% vacancy rate. When interest rates were really strong, we're seeing cap rates in that 3 to 4% range in the Lower Mainland. So, logically, if interest rates come down, there's a lot more room to play if you're buying at a higher cap rate right now.
So, Meg, I'm going to jump in here real quick and just throw some investment philosophies out there.
Yeah.
So when you're buying an asset, if I can buy in a marketplace traditionally, now again, we do have higher cap rates right now because of interest rates, but if I could buy into a market traditionally that was growing, that market might experience what they call cap compression. So what cap compression is, so if I buy a building, let's say, for example, at a 5% cap rate on the exact same income a year later, but now they're selling at a 4% cap rate, the value of that property is increased by 20%, purely based on what we call cap compression. So if I have $100,000 in income and it sells on a 5 cap rate today, I have $100,000 in income and it sells on a 4 cap rate next year, my income hasn't changed. My building has gained 20% by cap compression. So traditionally you'd find that when you buy like Victoria, where as markets grow and expand, more demand comes in, cap compression kicks in, more people want to buy, prices get higher. Right now, you can experience cap compression, potentially buying things just anywhere because of high interest rates, which is a false indication of the true value of that asset. And I think if you can get into a position where you might have cap compression kick in, my lease rates might go up. Now I'm making money on 2 sides of things. My income's going up, the cap compression's kicking in. And then third factor is the tenant pays my mortgage off, which is the traditional real estate investing model. If I can get that 3-prong approach to investing, that is something people will buy all day long, which for the longest time, we haven't been able to experience that in the lower mainland really because the cap rates have been so low. But because interest rates have obviously pushed cap rates higher, there might be that false indicator that you might be able to buy something at a 5 or maybe a 6 cap rate. 6 might be a little high, maybe a 5 cap rate that was selling at maybe a 3 cap rate down the road. Not necessarily say you'll ever get back to 3 because in COVID, money was so cheap. That also had indications on why cap rates got so low. But you can make a pretty good guess that it's going to go from a 5 to a 4. That's 20% gain in my property value just through cap compression.
Absolutely. And so I think with groups that are well capitalized right now, it's, yes, you're probably putting a higher percentage down just to secure the financing you need just with the debt service ratio. But as those rates start to come down and you see an opportunity at lower cap rates, that's the time to, refinance and take that capital out that you once put in. And then it starts servicing itself a lot better.
100%.
So I'd say those who, there was a lot of groups that were very bullish when the interest rates were low for obvious reasons. But when we were in multiple offers, maybe they didn't pick up the investment properties that they like and they hadn't added to their portfolio. And so I do believe there's still a lot of capital in the market that's kind of sitting and paused. And, what's going to happen as soon as the interest rates start to reduce is that all those same players plus some will start entering the market and it'll drive the price up again.
100%.
So I think now is definitely the time to, take a little bit of a risk, structure financing in a way where, it's flexible and you can kind of change gears as things start to improve, but you've secured a price at this market, right? So I think that's key. And, if you do have the capital, I would say it's a great time to be bullish right now.
So in saying that, if I'm an investor and I'm looking at the office market, let's go back, say, pre-COVID. If I was going to buy an office building, let's say in the greater Vancouver area, what traditional cap rate would I maybe find on that asset class?
Like right now?
Let's go back a few years, say pre-COVID versus what we see today.
Yeah, I mean, I would say pre-COVID, depending on, a number of things, if there was land use changes. But, traditionally for investment properties, you're probably looking at 3 to 4%.
So let's say 3 to 4%. Now, we can probably make a good guess that maybe 3, 4, 5 years ago, the rents were less than where they are today.
Yes.
So if I fast forward to today and my rents maybe are slightly higher, which will impact the price, than where they were 3, 4, or 5 years ago, what type of cap rate could I get today? And this cap rate is mainly driven by interest rates. The asset hasn't depreciated itself. That you're like, wow, it's half price. Cap interest rates are pushing prices down because the cost of debt and loan to values. But where would I find a cap rate maybe in that same comparison area today?
Yeah, you're probably in the high 4s to low 5% cap rate range.
So
and
high 4s to low 5s.
But I would say in general.
So if we take that number, we're saying potentially, and again, we're just using, these are all hypothetical figures. I might get the same asset that I once paid for, let's say 3, 4, 5 years ago at a 20 or 25% discount, purely because the cap rate has risen because of interest rates. That if I buy that thing at a 20 or 25% discount and the cap rates compress back to 4, that's my equity gain in the asset.
Absolutely. Yeah.
So now the question becomes, that all makes logical sense. Does the office market continue down the road 3 to 4 years from now, where the vacancy rate gets better, all that stuff, that we will see a desire for office space, making office market that much more attractive today for those who are going to play the speculation game?
Yeah, I mean, I think, the work from home aspect, that is starting to recover. The supply issues that we noted, I think there was a big boom of supply that entered the market. As that starts to absorb, we start to reduce the vacancy rates. And, the tenants that are out there are not as spoiled for choice. And I think that's the key, is that, when they have, 10 options to choose from, there's less urgency. They have the time to, sort out their options, and they know that there's no rush. But as that starts to reduce and there's no new supply coming to the market, that has a bit of a snowballing effect where there's only 2 options that work for them, and they would be heartbroken if they didn't get one of them. So, it starts to move the market a lot quicker. But yeah, I think there is definitely an opportunity in the office market because it is at a low. And prior to COVID, it was so strong. It's, hopeful that it'll return to those rates again.
Well, I think if we look at it too, and some great examples out there, like if you look in, we talked about downtown Vancouver is just that. It's like an island almost. North Vancouver, again, that's got the same mountainous and water challenges. We talked about the development costs of office space might make it tough even to build office in the future type of thing. And also one thing too, I think we didn't talk about is so many of the opportunities that may exist out there are not stratified opportunities, meaning they can't be sold as individual offices. And a lot of the offices that are built are maybe built on a lot larger scale that they price a lot of people out where people don't have 40, 50 or $100 million to buy them.
Absolutely. Yeah. I mean, that brings up a good point. Our team just listed a 26,000 square foot, 4-story office building at 2030 Marine Drive in North Vancouver. So beautifully renovated in 2019, sitting on about 14,000 square feet of land. And it's like 3 minutes from Lionsgate Bridge.
Okay.
So now the owners have put a lot of work into this building and they're actually sitting at a 95% occupancy. So, that's a pretty strong sentiment in this market where, we're seeing higher than normal vacancy rates. And the building itself generates over $1 million in gross revenue. Current NOI is $830K. And so, Cory, thinking back to 2021, I think it's safe to assume like a cap rate in the range of 3.75 to 4% for this building.
I think it'd be very, very fair for the North Shore there.
Yeah, which is approximately 20 million. So, and that would even attract a lot of investors back in that time. So we are marketing this property for 14 million. That's 6 million less than what it'd be worth in 2021, which is a 6% cap rate.
Okay, wait, stop. Let me compress this for a second here. So this is the exact examples that we're talking about. So you said your team listed a building at a 6 cap rate, like 6%
cap rate in North Vancouver.
And that market was probably closer to a 4.
Yeah.
So then we're simple math says that hypothetically or potentially is a 33% discount of what that market once was at one point.
Absolutely. Yeah. And it's, turnkey building. It's beautifully renovated.
What's the occupant? No, here, okay, I'm a devil's advocate. What's the occupancy rate then?
95%.
95% occupancy rate.
And they have a wait list, for certain units, the ones that have windows, they have a wait list for those units. And so, they've been consistently in that 90% to 95% occupancy, due to a lot of effort, but there still is demand. It kind of shows you there still is demand, especially in these suburban markets where you're getting medical groups and, 2-person law firms and, very local businesses that aren't affected by like the tech boom and everything. And so, they've been able to maintain this. And you wouldn't see an opportunity like this for 14 million 2 years ago, maybe even a year ago.
No, I totally agree with you on that.
Yeah. So it's a prime example of where there's ample room for cap rate compression once the lending market becomes more favorable. And then you experience significant gain in property value. So
I think one thing too is if you look at the North Shore and maybe you look at Surrey like 10 years ago, one of the complaints with Surrey was the bridges. And now Surrey's done a phenomenal job of creating a place where you can live and work and pretty much do everything. In Surrey, they've taken the bridges right out of play. And I think if you look at North Vancouver and West Vancouver, obviously the bridges were always a concern. And as more people move over there, the bridges will become more problematic, just trying to get people to and from. That if they can continue down the road of having these great infrastructures, if they can implement that in North Vancouver and create it as a spot where you can like live and work and all that stuff, not have to sort of come over those bridges, that will take away a lot of concerns on North Vancouver. And when you look at, the post-COVID market where the office market obviously has been impacted by it, but maybe there's a hybrid model or whatever it is. If you can live in North Vancouver, which has a tremendous population growth and development growth right now, and you can work in North Vancouver as well, an office building or offices buildings, this one or any of them over there, might become even more desirable in the future as more population goes over there and people want to take the bridges out.
Exactly. And like as we mentioned before, like the Fraser Valley, we're seeing more satellite offices to kind of curb that objection. Bringing people back to the workplace is really challenging in downtown Vancouver. I think, people got accustomed to not having commuting times. And so, that's where we're really seeing strength in these, outside markets, suburban markets such as North Vancouver, because, if their employees live in North Vancouver and they set up an office there, they're more likely to come in.
Yeah, no, I Totally agree with you. So that's a great example. We're talking about opportunity in the office market. And I think one thing too, when investors look at the office market, unless you're getting into the large scale buildings, a lot of the stratified offices that are out there is for the developers to kind of get top dollar for those strata lots is traditionally they're sort of pitched more towards owner occupiers.
Mm-hmm.
And when you look at, let's just take the Langley market as an example. If you go back, I don't know, 6, 7 years, 8 years, maybe give or take, you could find shell office space out there for probably like $300 a foot.
Mm-hmm.
And now you can find shell office space out there for like $950 to $1,000 a foot. And when you're an investor and you're looking at that $950 to $1,000 a foot for an office space, it's going to be very hard to make the investment numbers work, because by the time I buy the unit, tenant the unit, have to pay my landlord inducement costs and commissions and all that stuff, I might be getting like a 3 cap rate or something like that. And if my cap rate gets so low, my down payment has to be so high to create cash flow, my leverage position is gone. So the office market, for the strata market now at today's pricing, is these things are pitched at owner occupiers more so than investors.
Yeah.
What you just talked about there is it seems like a very rare opportunity from an investment standpoint that you can get I'm trying to think if I've ever seen a 6 cap rate in North Vancouver before.
I mean, Fort St. John maybe a while ago. It's shocking.
You're getting an extremely high cap rate in a marketplace with a building that's just over 20,000 square feet that the investment numbers make sense. That's hard to find in a lot of cases when you're looking at office right now or for the past few years, because the strata ones have been sold at such a high price per foot, mainly to owner occupiers who are going to occupy themselves and not really looking at the investment market. That you can't, or you got to buy the $100 million building downtown, which none of us have. I don't know. Adam probably has it because he has a house in Kelowna. But most people don't have $100 million to buy these buildings.
Yeah.
That you can't really find the investment opportunities as much as we probably like to. And that seems like a very rare. I'm still trying to wrap my head around the 6% North Vancouver. It seems very, very rare.
Yeah. I mean, that kind of touches on another point that I didn't bring up, is that this building is also stratified. So it's one single owner, but there's 16 strata lots. So, it really opens up a lot of opportunities for investors, occupiers, kind of a quick cash return. So, if you were to purchase this building for, let's say, $14 million, there are still 16 strata lots that you could sell up individually. And so with any kind of large scale project, the price per square foot is going to be lower if you're buying on scale. However, when you have 16 units that are roughly around, let's say, 1,000 square feet, the premium on the price per square foot is going to be a lot higher. So this building is priced at approximately $550 per square foot. But if you look at the strata office market in North Vancouver, their average right now, so last couple of months, is around $915 per square foot. So if you're not interested in investing and having this as a long-term investment and enjoying that wonderful 6% cap rate, there is an exit strategy too, where you could sell off the units individually for a premium, because it's already structured that way. There's not a lot of legwork to do. It's just, converting them back. It's already stratified, setting up the CRF and, making that kind of instant profit on the property. So it's a really interesting one.
So this just plays more factors into what we're saying is maybe this is the time to buy the office market, because it's not as coveted as it was a few years ago. That these opportunities exist now, that maybe they're at these prices now. I know we have a great listing, and I can't give the address away just yet, coming up in Kamloops, but it is a tremendous, I'd say small scale office building.
Cool.
Bank anchored, it ticks all the boxes.
Yeah, something you never see.
Yeah, and it's gonna have a 5 cap attached to it, and when we can finally bring it out with the underground parking and announce who the tenants are, like this is something that would probably sell closer to like a 4 cap rate a couple of years ago, even in a market like Kamloops, because there's such limited product in this particular asset class in this particular area of downtown. But you got AAA tenants, so I mean, it's going to be listed at a 5 cap on current income. And there's probably upside on that income as well. So there's another argument that potentially this building is maybe being sold at 20% cheaper now than what it potentially would have went for a couple of years ago. Just all things considered with the interest rates and the tenant pool mix in this building and location. But that's another great opportunity that even seeing that, I was really surprised to see the cap rate at a 5, all things considered, I understand it's Kamloops. It's not going to be like a 3 cap rate, but just all things considered, I was surprised. But that's just a prime example of the market that we're in today. That's a building that could experience cap compression in the future just on current income, and you've got solid tenancies. And that I would be very shocked if that building doesn't get a lot of interest really quickly once we can bring it out.
Absolutely. No, it's exciting time to be in this industry too. I mean, the past couple of years, it's, you're working with buyers and there's just limited opportunities, and the ones that come up that are, somewhat exciting, there's, 10 other groups that are looking at it, and you're bidding the price. And, if it comes to market at a 4 cap, it might even compress down to like a 3.5, just given the interest. And so, for those who are well capitalized, it's a really exciting time to be in the market, with less competition. Your power is the equity you have and kind of the foresight that you're going to see cap compression, or maybe you find a property there's a repositioning play and you have the luxury of doing that as well. So, I think it's, the media obviously is focused on interest rates and doom and gloom, but I think there's so much pent up demand that is now able to be serviced. And it's a healthy thing for us to go through this in this market.
So the takeaways from today is the investment office market might be a lot more lucrative than we think it is if you can get a good deal, all things considered, even interest rates, on something today, well positioned, location. That could experience cap compression on the same income. You might be able to get a fairly good lift, 20, 25%, again, just hypothetical numbers, on that building with the same income, which will give you the opportunity to refinance capital out of it at a later date and still be well positioned in an asset class that will probably see a decline in vacancy in the coming years versus a continued increase that we've seen coming out of the post-COVID era. Is that what I'm reading?
You nailed it. Yeah. Don't say it better myself. You're listening.
I just checked my pocketbook for $14 million. I can definitely tell you I'm about $13,999,000 short. So I'm out.
It's not going to sell for less than 14. I'll tell you that.
All right. I'm out. Well, again, so Meg, before we let you go, we appreciate taking your time because we know you're very, very busy. We have our 6-pack of lighthearted questions we ask all of our guests. Do you have just a few more minutes for us?
I do.
The 6-pack is powered by our great friends over at Red Point Law.
Oh, the guys at Red Point Law are fantastic, Cory.
For all your legal needs when it comes to commercial real estate, visit them at redpointlaw.ca.
All right. Your favorite bar or restaurant?
Favorite bar or restaurant?
Ooh, okay. Favorite, I'm not going to say bar. I'll say restaurant. Okay. Probably L'Abattoir in Gastown.
Oh.
Yeah, it's just kind of moody. I had a really good steak there a couple of months ago, and I can't stop thinking about it. Yeah.
Well, that really good steak's going to lead us into our next question. So unfortunately, you've done something horribly bad and you found yourself on death row. You are allowed one meal before it's all said and done. What meal are you having?
Well, I'm not going to say steak because that's just too obvious. I would say some lobster or like crab.
Oh.
Yeah, especially in the summertime, it's just so good. Lots of butter. Yeah, just simple lobster or crab.
Any particular waterfront restaurant you're going to drag Chris to have that meal?
Oh my God. I guess Provence.
Oh, downtown Yaletown.
Provence?
Yeah, downtown Yaletown.
It's like kind of waterfront, right?
Yeah, it's great seafood right on the seawall.
Yeah. Now I have to take him. Damn.
No, he has to take you now. I just threw his name out there because now he's stuck.
Because I'm on death row.
Yeah. Well, it's the last time he's going to see us, so you might as well make it a good meal.
Okay, fair enough.
All right, next question. Favorite band or musician?
Ooh, okay. I change it up every single time. I'm really on the Fleetwood Mac train again.
Oh.
Yes.
Something about summer, Stevie Nicks. Yeah, I've just been like playing it on my way to work, as well as the podcast, of course. But yeah, no.
Speaking of great, Melissa, I'd like to know who your favorite band is because I was on the phone earlier before I got here, but I was on the phone outside, and this car comes down the road and it's full blown techno. I thought I was in a nightclub. I was reaching in my pocket to try to pay somebody cover, and Melissa pulls up and gets out of her car.
I have a very diverse music selection.
Yeah.
Techno, EDM is one of my favorites.
It's also 9:30 in the morning, though.
It was 9:30 in the morning. Okay. I think I was scaring everyone I was driving past on the street. I had an Uber driver wave at me. He was excited about the party that was happening. But I also love Fleetwood Mac. I have their vinyl record, and
everyone loves Fleetwood Mac.
Who doesn't?
And Nickelback, right? So, all right. Next,
slide that in.
next one up. Meg, a book recommendation for our listeners. And doesn't have to necessarily be real estate related.
So you actually recommended this one to me, How to Win Friends and Influence People. So I've just started reading that. I've owned it for a while. I just never got around to reading it. And then you kind of poked me and were like, okay, you got to read that book. And so I'm just starting that.
It's a classic.
Right, classic.
Yeah. Great. Awesome.
Yeah.
Well, okay, next question. Your drunk karaoke song. You found yourself at a bar. We give you a microphone. What's
you guys
Meg
know
singing?
me so well.
So Chris took you to your favorite restaurant in Gastown. You're having your lobster there, but the wine has been flowing nonstop. Your favorite restaurant turns into a midnight karaoke bar and someone shoves a microphone in your face. Okay.
Well, yeah, I love karaoke and I love drinking. So probably Lean on Me, Bill Withers. It's a crowd favorite.
I was going to say that gets the crowd going.
Right?
That's a good,
each other just swaying.
Yep.
It's really wholesome and nice.
So I love it.
That's great. I pictured you more of like a Photograph by Nickelback karaoke. But I guess we'll take that as a close second.
I take requests. So whatever you want, I will sing it.
All right, there we go. Okay, Meg, last question up. Something you've purchased for $1,500 or less that's had a positive impact on your life.
Oh, my paddleboard.
Oh, that was a quick answer.
Yeah, no, it's like $1,500. I was like, it's about that. Yeah, so I live in Port Moody. I'm pretty close to Rocky Point, just like by the inlet. And it's a inflatable paddleboard. And it's so nice, like very calm in the inlet and just kind of buzz around, maybe crack a beer or two. But yeah, it's really nice. And then I, go along the little coast there and see all the beautiful homes that I wish to have one day. And it's been really, really nice for me to have that.
Awesome, Meg. Yeah. So how can all of our listeners find out more about what you're doing, your listings, this 6% cap rate thing that just seems out of control? How can people get a hold of you?
Yeah, so you can reach me on my cell, 778-960-5979, or at my email, which is meg@williamwright.ca.
Well, Meg, thank you once again for taking the time today to talk all about the office market and the opportunities that exist. And we appreciate it.
Of course. Meg. Okay. Thank you, guys.
Thanks, Meg. Take care.
Okay,
Bye-bye.
Bye.
There you have it, folks. Our interview today with Meg Cooney of William Wright Commercial Vancouver.
Really great to talk with Meg.
Surprisingly, did we change your thoughts on the overall office market?
You know what?
The opportunities that exist.
You don't know what you don't know.
Exactly. See, if you watch the news, it sounds like nobody works from the office anymore.
Yeah.
You read in the States about these places that are getting foreclosed on and all of that stuff, that you would think the office market is just like the absolute worst investment in the world.
Which makes it an opportunity.
Maybe your best opportunity, right? Because where people get excited about buying certain things is when that asset class is really hot.
Yeah.
Low vacancy, high rates, but they're going to sell at premium prices versus right now, the occupancy rate may not be as high as it once was, which it was very unhealthy for tenants. Now might be the opportunity to buy in, get some cap compression, market picks up, everything will be fine, right? And there's a lot of product that's coming to the market, new product that's hasn't been absorbed quite as fast, that may have some impact on those numbers out there, that they may not be as bad as you think they are.
Yeah.
And even still, they're not very bad at all.
I like that thinking.
All right. So for all those who want to buy, sell, or lease commercial real estate, they can reach us at our Vancouver office at 604-428-5255. They can send me an email anytime, Cory@williamwright.ca. Always happy to talk real estate. Or they can visit our website, williamwright.ca. Sign up for the latest and greatest news in the commercial real estate world. And for all those who want to sell their condos, houses, and agricultural land at record high prices, Melissa, how would they get a hold of you?
You can call me at 778-869-4477 or email me at melissa@vancouverrealestatepodcast.com.
All right, guys, thanks for listening. And we have another great episode next week. Take care.
All right. Take care.
Subscribe today.